just keeps going through. General Employees Pension Board to order now. Pam, if you could please take the roll.
All right, Patricia Draycott,
Here.
Commissioner Williams, Ernest Arnold, Brad Cowsell,
Here.
Bill Collar.
Here.
All right. First item on the agenda is public comments, as we have no one in the public here today. Move on and close public comments. The next is the, can we help you? Next item on the agenda is the consent agenda, approval of the minutes, quarterly meeting minutes for August 18th, 2022, approval of expenses, 2 invoices for Burgess Chambers. Good afternoon, Commissioner.
I forgot that there won't be an early release anymore.
Is that because you got in trouble?
No, early release for schools. Usually there wouldn't be schools. So it's late. But nobody fixed the clocks. I'm really late.
Okay, we're on the consent agenda, approval of the minutes, quarterly meeting minutes, August 18th, 2022. Approval of expenses, 2 invoices for Burgess Chambers, 1 invoice for Sterling Capital. Retirees, we have 3, Colleen Matheny, Divine Buttram, Eric Pratt. Old business,
Need a motion?
no, I need a motion to approve the consent agenda.
Move to approve the consent agenda and acknowledge the retirees.
Second,
I'll second.
all those in favor, please say aye.
Aye.
Moving on to old business, there is none. Moving on to new business. Sterling Capital Quarterly Report. Blake, you're on.
Good afternoon, everyone.
Good afternoon.
It's a distinct pleasure of reviewing this quarterly performance. And for pleasure, very, very loosely. This was just an awful period, guys. And it was really just an awful month. You know, when we got together last time in August, we were talking about how July had just rebounded pretty nicely, coming off a really bad second quarter, and things were moving in the right direction. Didn't have a lot of clarity on where we were going, but we certainly didn't see this coming in. September was just awful. We got another jumbo size, 3/4 basis point increase. We got 2 of them during this most recent quarter. Again, 1 in July and 1 in September, and you know, just looking at maybe, I think this might be the next one in December when the Fed meets. Is the market has 50 basis points priced in, and instead of 75, so it's moving in the right direction. But that's about as good as the news gets right now, because where we are in the cycle is everybody is just so focused on what the Fed's going to do, when are they going to stop raising rates, and until we get a lot more clarity on when that's going to be, we're just going to see this kind of volatility. It's just been really, really difficult. It really stinks because, as you guys know, September is our fiscal year end, so you never want to see a negative 8-9% month, you know, just as we're getting to the finish line. Bit of a silver lining, it rebounded again, at least so far this quarter. I don't want to, you know, I don't want to jinx us like I did last quarter, but we have bounced back and sort of recovered most of the September drawdown. But again, you know, the actuaries are still going to have to use that September 30th number. And the other silver lining, or the other really, I think the thing that we've been trying to emphasize and have the board focus on this quarter is, yes, this was a terrible year. There's absolutely no sugarcoating it. But if we go back and just look at the fiscal year 2021, chances are show you just how terrible, if we go over to, behind tab 2 in my report, you'll see it. The first page is, really a bunch of the market indices on it. Up at the very top are the equities, and then the fixed income is down at the bottom. Very first row there, we have the Russell 3000 index, kind of the broad U.S. benchmark, off over 9% just for the month. That left us off about half of that, or about 4.5 for the quarter, and then for the year to date, almost 25, and then for the 1 year period, or our fiscal year, off almost 18%, or 17.63. So that tells you just how bad a period it was. Saw a bit of a rotation. It really was the growth names that really got hammered in the first part of the year. They kind of bounced back a little bit this quarter, but they still were very, very negative. There was nowhere to run, nowhere to hide. But to put it in perspective, the only positive equity index on the page is the Russell 2000 growth, and it was up a whopping 0.24% for the quarter, but it was still off almost over 29% for the year. So again, it was just off from an absolute perspective for sure. I think the thing that that makes this particular drawdown so different than any I've seen since I've been doing this, going back to the late 90s, whether it was Y2K, whether it was the financial crisis, we've seen stocks go down 20, 25% in a pretty short period of time. We saw it just as recently as the COVID pandemic in early 2020. What we haven't seen is the Fed having to raise rates the way they're doing it. So in those periods when stocks were off, bonds actually were sort of a buoy or a ballast to the portfolio, right? They were up double digits when stocks were off 20, 25%. This time, bonds are down just as much. If we look at the Bloomberg aggregate, off another 4% for the quarter, off over 14.5%. And as we sit here today, it's even lower than that on a year-to-date basis. So it's just been a very, very difficult period as the Fed has raised rates. They all but have come out and admit that they were probably a little slow in siphoning off some of the stimulus that they had poured in post-COVID. You kind of want to give them a little bit of a pass because nobody knows how to reopen the global economy. We've never done it. There's no roadmap. There's no right or wrong way to do it. They were doing the best they can, but obviously we pumped a little bit too much stimulus in here. And it wasn't all just reopening inflation. There was real systematic inflation going on too. So until we sort of work our way through that, it's going to be kind of more of the same in our opinion over the remainder of this year. If you look at what the futures markets already got priced in, they've got that 50 basis point increase when the Fed gets together again in December. They've probably got 1 or 2 more in the first part of 2023, and then they've kind of got a pause priced in there. So that's kind of a best guess as we sit here today. A lot of that could change though, because there are so many variables that obviously impact that. And it's a little bit unusual, and Larry and I have talked about this for the last 6 months. It kind of doesn't feel like we're in a recession or things are this bad, because we're getting really good jobs numbers. The corporate earnings are solid, if not spectacular, but we're kind of anticipating that when we're starting to see some signs of it in the data, that all of those Fed increases over the course of this year are really starting to take hold. And you can see it sort of bits and pockets of the data. The employment data, no, but almost every other area we're starting to see, okay, things look like they're peaking a little, they're starting to slow down. Inflation is coming down ever so slightly. So from that perspective, the one thing I can say with any kind of certainty is we're probably a lot closer to the Fed stopping this campaign of raising interest rates than we were at the beginning of the year. But that's about all we can say with any kind of certainty. It's very little solace. It's been just a very terrible year. I mean, the single worst year I've ever had to come out and report to clients by far. So, but again, we're in this together. We're going to stay focused. We're going to stay disciplined. All of our managers are still looking at their individual companies and sectors, trying to find the best companies that are going to hold up in tough times, that are going to outperform when things start to turn around. And thankfully, we are a pension fund, so we need to look 20, 30, 40 years from now to be able to pay all of the pensioners. So we're going to stay focused on that, stay disciplined. And there's a lot of good, solid companies that candidly are 15, 20% off of where they started the year, so they're on sale a little bit. It just may take a while to realize some of that value. So as always, guys, there's a lot more in my first section that kind of gets into the bigger picture and the economics and dissects all of the various submarkets. And in a nutshell, nowhere to run, nowhere to hide. Didn't matter whether you were a big company, little company, focused on dividends, focused on growth, international, domestic, everything was off, and it was off pretty considerably so far this year. Give you an idea just how bad. But before we switch gears and talk about performance, let me just stop and see if there's any questions, you know, on the sort of the forecast or what went so wrong or.
Quick question.
Sure.
The dollar was really strong against the euro, 2 weeks ago, and now it's 103. How'd that happen?
I think some of it was probably the euro, and rallying a little bit. We're starting to get at least some headlines, optimistic reports, I wouldn't call them headlines, about the situation over in Ukraine and Russia. So maybe that's getting a little closer to some sort of clarity or a resolution. That's probably helped their currency a little bit. And I think that's probably the biggest driver, Skip.
And then it was kind of coincidental with the election. Right after the election, it went the other way.
Yeah, and you got to remember that, I know it's not that the pound is sort of its own separate little entity, but the whole situation over in England with their prime minister probably rocked, those currencies a little bit too, so it probably swung in one direction versus the dollar. Kind of swung back when things kind of calmed down.
Do you think this new prime minister is going to take them back into joining the EU?
That's a good question. I'm not sure if you have a Brexit instead of a Brexit, but yeah.
I don't think so.
Yeah.
Not gonna happen.
I think you're gonna
Yeah,
say
probably not, but.
Too much work.
Again, don't rule anything out at this point, right? I mean, nobody thought they'd have 3 prime ministers in the course of, 3 months either, so, kind of unusual scenario. So guys, again, with our piece of the portfolio, remember, we're managing the domestic equities and the fixed income. And again, these are some of the worst numbers. I can't believe essentially a 50% U.S. stock and a 50% bond portfolio kind of yielded this. But over on the first page of my report are the cash flows. Nothing real earth-shattering there for the 6 months since we transitioned. But over on the next page, we can put some percentages to those dollars for the quarter. You see our portfolio is off about 4.42, ever so slightly ahead of the benchmark, basically in line with it, off about 4.5% as well. And then for the 6 months since we transitioned, slightly ahead. You see that all the way out there to the far right. Slightly ahead, but in no way, shape, or it's a negative 14% return in 6 months. What I call it a good performance. But it certainly could have been worse with the benchmark off a little more than 15% there. So a lot of the other data in my book is really going to be a lot more meaningful when we get a little bit more time under our belts. Like, for example, on the next page, we've got some risk statistics that show how much risk we're taking.
What page are you on?
I'm on the very next page, which would be 17, Skip. Should be about the 3rd page in
Yeah, got
that
it.
section, I think.
Yeah, you didn't tell us when you switched sections.
Oh, sorry about that. Took it back up. So yeah, over on page 17 on the top there are some of those risk statistics. Again, not really enough data to be meaningful, but certainly, some of the things that we're pointing out is, the standard deviation is a measure of volatility. We've taken a little less than the index. That's what we, again, try to strive for there. And then beta is also another measure that kind of shows how much the portfolio will go up and down relative to that target benchmark. So if that benchmark goes up 1%, we would expect our portfolio to go up about 94 basis points, or just slightly less than that full 1%. And then conversely, if the market goes down 1%, we should go down a little bit less. And then lastly, out there towards the end, we've got the up capture and down capture. Always want to try to get as much of the good markets and as little of the down markets as possible. But definitely, again, 6 months isn't really enough data to make any determinations, but we'll monitor that going forward. Next couple of pages, we've got the asset allocations and then a lot more detail on the asset class performance to finish up the section. We've got a little bit more in stocks than we do in bonds right now. Only that was more in response to the big June sell-off. That's when we went to a slight overweight in stocks. So it helped us a little bit in July, kind of hurt us a little bit in September, it's helped us a little in October. We kind of maintained that slight overweight as we sit here today, but nothing significant, because candidly, our conviction in the market worth of data there because that change was made in first week of July there, so we only have most of the quarter, but not quite all of it. So again, not really anything earth-shattering here with such a short period of time, a couple of quarters to look at, but again, we'll monitor these a little bit more closely and obviously make changes like we did with the small cap value offerings from time to time, and I'll come back and tell you the rationale. Really the rationale for the small cap change was we do like that the Hotchkiss line is a little more broadly diversified. It's a little more stylistically pure, it's a small cap value, and that's a class we want to get a little more stylistic exposure to, as opposed to a little broader Kane Anderson that's a little bit more all over the place. So with that, guys, there's, all the holdings are in the next section. There is one last slide I wanted to kind of show you. That first page of the appendix, and we talked about this last time. Since we did transition, we want to still be able to show you how our piece of the portfolio is done historically. So what we did was we kind of linked the old SunTrust and Truist performance to the new performance under Sterling, and come up with, graded us versus our benchmark. The only number that I don't have any confidence in is that inception number going back 20 years or 21 years. I know we've changed our targets several times over those last couple of decades, so I don't think that one's accurate. But I do think that the 1 through 10 numbers really are a pretty good representation of our piece of the portfolio versus our target as it's evolved over the last 10 years or so. Those of you that remember that didn't go all the way back, we used to have all of the portfolio at one time, and then we started diversifying away. So we've changed that benchmark a few times to kind of more accurately represent just our portion of the portfolio. So again, off 16% is sort of that fiscal year to date number for the Truist Sterling component. Again, it's slightly better than the target, but by no stretch anything to write home about. It was certainly a terrible year by any measure. With all that doom and gloom, any questions, comments, thoughts?
Yeah, what are your thoughts on as we go forward? Because we were just talking about this with Larry. The feds are still talking about more increases in first quarter to be followed by dropping it.
Yeah, and that drop in it over the last 90 days since we last met has gotten pushed out a little farther into 2013. So there's sort of a bit of a longer pause as they've kind of rushed and the market has priced in increases, Fed increases a little sooner than they had otherwise. So that pause has gotten a little bit longer, and so then when they're going to need to dip, it's gotten pushed out a little bit farther too. So from that perspective, it's pretty tough, Tricia. I mean, where we are right now, until we get more clarity on exactly when they're going to stop, they're
Still-
as good as mine on exactly when that's going to be.
So you think we're going to get another bad quarter?
Well, it's hard to say that as we sit here today, the first 6 weeks or so, in the portfolio, I was looking at our piece of the portfolio, we recovered everything we gave up in September. So we were up, 6, 7, 8% just for the 6 weeks. But it was very similar to where we were last quarter. So I
Right.
don't want to put too much into a short period of time, because we've got 6 more weeks, and anything could happen, as we saw like this last quarter. But from that perspective, we are only 6 weeks away from the finish line of 2022. And I think a lot of financial professionals would be very happy to put this year in the rearview mirror and sort of focus on where we're going to go next year. And it does look like, I think our best guess is we'll probably get a historically normal year, which would be somewhere in that 10, 11% out of stocks for 2023. But as I've sort of caveated every forecast, it's as cloudy as it's ever been. The amount of conviction behind any forecast is very, very difficult, very, very low at this point compared to where we've been, for the better part of the last 10 years. I know that's not the answer you want to hear, and I know it's difficult, but it's kind of where we're at.
Even if they do start cutting rates, they'll do it like 25 basis points at a time, so they can say they did it, but it's really not going to make much difference.
Yeah, and I guess that one of the things that we're really recession. But make no mistake, their first and only focus right now is making sure inflation stays in check, period. Great question, sir.
All right, all right.
Thank you guys very much.
Thank you, Dwight. Next new business is our quarterly report from Burgess Chambers and Associates.
All righty, well, good afternoon again. Kind of just follow up on those comments. You know, historically, the Fed they hit it too hard going in, and they hit it too easy, I guess, going in. They're too loose with rates going down, and then they hit it too hard going the other way. So I think there's still a pretty good chance that in the second half of 2023, they'll have to hit the brakes, because if they do another 50 basis points and maybe another couple rate hikes between now and, say, June of next year, I think there's a good chance we will be in a recession, a full-blown recession by then. The yield curve inverted, which means, you know, short-term rates are higher than long-term rates. The 2-year Treasury to the 10-year Treasury now is inverted steeper than it's been in 22 years. I just heard that coming over today. So that's almost 100% guaranteed prediction of a recession when you get that. So I think there is one around the corner if we're not already there. On the positive side, it is going to take a long time to get down 2%, but on the positive side, if you look now, I don't know if you remember me getting kind of nerdy about 6 months, nerdier than usual, about 6 months ago maybe, talking about the PPI versus the CPI. And it wasn't getting much press, but at the time, for several quarters in the last year and a half, the PPI was running at about 4% or more higher than the CPI. And the CPI is retail inflation, that's what you and I see. The PPI is think of it as the wholesale inflation number. Well, that was significant because if the PPI is running at 11 and CPI was running at 8, or it was running at 12 and CPI was running at 8, that tells you that the producers have not passed on those costs yet to the market, to the retail, to the customer. And so there was more inflation in the pipeline. Either that or companies were going to continue to eat it and their earnings were going to get impacted pretty dramatically, which would be bad news for the stock market. So I think I said at that time, one of the things we want to see is that gap narrow between the PPI and the CPI. That's a good sign that inflation may start taming down a little bit. Well, in the last report, I think PPI came in at 8, CPI came in at 7.7, somewhere in that range. So the gap has narrowed quite a bit. So that means the supply chains are starting to free up a little bit more, and that should help. You know, if you get more supply, then demand is dropping just because the economy's kind of going in the tank a little bit. If demand drops and supply increases, that should reduce prices. I mean, economics 101. And so I think that's a kind of a bright spot, I guess, out there, is that we might have seen the peak of inflation. It's still way too high, and the Fed will continue to be pretty aggressive, but they'll probably overdo it and have to hit the brakes, or stimulate the economy, I guess you'd say, back at sometime in 2023. And it will probably be in small increments, but I believe you would see the stock market react extremely well to just the hint that they're going to lower rates, start lowering rates again. Because right now rates are high enough that it's taking money out of the stock market. There's just no doubt about it. A lot of retirees have had to live with 1% savings accounts and that kind of stuff now can actually buy 2-year treasuries at 4%. They can buy 2-year corporates up at close to 6%. So if corporate bonds. So there's alternatives out there now. Bill was kidding me about my TINA comments back in the day when rates were really low. We said stocks are going up because there is no alternative, kind of the TINA rally. Well, the TINA rally is kind of over. There is an alternative now, and that alternative is you go over and buy a 2-year bond, 3-year bond, and you'll be pretty happy with a lot of people will be pretty happy with that rate. Now the reality is they're still losing 2 or 3% to inflation. If you buy a 4% bond, you're still not keeping up, but that's better than losing 10 in the stock market, right, or 20. And so, so we have seen that impact. Earnings, as Blake pointed out, earnings have come in fairly strong, continue to come in fairly strong, but we're starting to see really mixed results there. And a great example of that was just this week. Target came out with horrible numbers and horrible projections. Walmart came out with great numbers and good projections. So it's kind of And there they are, the same, yeah, it's trade down. So all of a sudden Target was the Target, not Target, because it was the high end. And people were leaving Target to go to Walmart. And so it's, we're getting a lot of mixed signals right now, but we're definitely, I think, heading into a recession. Hopefully it'll be a mild one, but we're heading there. And we'll just have to see how the Fed reacts. If you turn to page 2 of my report, it just kind of echoes what Blake's already said. There really was no place to hide. The top of that page 2 are the various benchmarks. We usually like to see that flipped around. If you hold it upside down, it'd be a pretty decent quarter. But the only thing that worked was energy. Anything energy related did pretty well, but otherwise you didn't make any money in the quarter. That's just the way it was, and no place to go. Real estate did great. You'll see the real estate fund Predex that we put you in did very, very well for the last year, but REITs, which are real estate securities, they're basically stocks of real estate, they were down big. So it was kind of a mixed story even on real estate when you look at it from that perspective. If you look at page 3, this is what I think is the undertold story. Blake, of course, brought it up, but undertold in the press, I guess, or in the news, is what did happen to bonds. And to show you the extremity of this, I mean, you can see on the top of this how much they were down. Corporate bonds were down 17.9% for the year. Our treasuries were down 12.9%, so that's the highest quality you can buy, and they were still down 12.9%. When you think about this, and I was talking to Pam and Patricia about this earlier before the meeting, back in the early 80s, I was a bond manager. That was one of the things I did early in my career, was actually managing bonds. Well, back in the early 80s, Paul Volcker got a lot of credit for aggressively raising rates. He was the Fed chairman at the time, and you hear his name mentioned quite a bit. He raised rates pretty aggressively to stamp out inflation and set the stage for low rates and a pretty big stock market rally in the 80s. But his rate hikes were about, and they were aggressive, but they were about 50%, 50 to 60% is how he raised rates. But it was from 11, prime rate back then went from, if you remember that term, prime went from 11 to 21 and back to 11 in a 12-month period of time. So that's pretty dramatic, right? I remember buying, this is a little tidbit, but I used to manage Bobby Knight's profit sharing plan, Coach Knight, and I managed his fund, and I bought him a 20.3% 10-year New York Life guaranteed investment contract, 20.3% for 10 years back in that peak. But that volatility was causing people with 100% bond portfolios to lose money. Government bond portfolios, these profit sharing plans, and they're going out and telling them they lost 5 or 6%, even though interest rates were 14, 15, 16% at the CDs. So it was a strange market environment. But when you compare that to now, a year ago, the Fed funds rate was 0.6, I believe, and now it's over 4. So percentage-wise, you're looking at 4,000% increase, and that's what's killed this bond market. The Bloomberg Aggregate Bond Index started in 1977. I graduated from college in 77. That index started then. It's 45 years. 45 years of that index, this was the worst it's ever done. And the other little tidbit was that there's been 3 quarters in a row now where stocks and bonds were both negative. That hadn't happened in over 50 years. So even though I've been in this business over 40, I keep telling people, I've never seen it like this. This is really unusual. Usually you had the bonds propping you up when stocks went down. Didn't happen this time. Bonds got killed. So what's different is what I'm asking. Why are we in this? And the only thing I can come up with is we never shut the world down before and flipped it on at the same time. So you shut the world down for 1.5 years, 2 years, and then you flip the switch and everybody's back on. You got supply chain problems because they haven't been making anything, for a long time. So you got demand all of a sudden. Plus we put all that stimulus into the economy during COVID to keep things kind of going. I'm not saying it was good or bad, but you put a lot of money into the economy when you've got now demand is still up, but supply got destroyed when factories were shut down and all. And so I guess that's the only thing I can explain, because it's a very unusual time, and it has produced some pretty ugly numbers. If you'd have told me,
Can I ask you a question
Yeah.
before we change the page?
yeah,
So explain to me how the Bloomberg U.S. Treasury can be negative, because you can only make money on the Treasury.
no, they get marked to market though. You're true. If you buy a 4% treasury for 2 years and don't do anything with it, you'll get your 4% back, right?
Right.
But in the meantime, if rates go up to 8% and you try to sell that treasury bond, you're only gonna get 50 cents on the dollar because they can go buy an 8% bond. And they're gonna buy your 4% bond, they're not gonna pay you $1 for it. Follow me? So bond, if interest rates go
But
up,
if
the
we
market.
keep it to maturity,
Yeah.
doesn't
Yeah.
the Fed government have to give you whatever you bought it for?
Yes, you will get it at maturity. You'll get that money, but in the interim, bonds are priced at market. They sell in the market just like stocks.
It's the unrealized.
And we're required by law in your pension fund to, mark your plan to market every quarter.
So it's the unrealized gain loss. If you
It's
don't
unrealized.
sell it, no problem. But if you tried to sell it, you'd lose money on it.
You
Because-
couldn't get $100 for your 4% bond if I could go buy an 8% bond,
Why would you
the
buy
same
it for?
maturity.
Yeah.
Why would I do that? But I'd give you 50 cents for your dollar, and then I've got an 8% yield. Because you got a 4% coupon, but it's 4% on my $50 instead of 4% on my $100.
Yeah.
So that's kind of bonds 101.
Yeah, very simplified example. but
Simplified
that's how it
example.
works, too.
That's how it works. Rates go up, market values go down.
30, we've got to show you what that price is.
That's why I mentioned the percentage of increase that the Fed has done. It's only been 4% from where they started. That's a huge percentage, and that's what's really killed these bond values, the market values. So,
Okay, thank you.
but it is different. Like personally, I've gone in and bought some 2 and 3 year Treasury bonds with exactly the way you're thinking. I don't care what the market value is between now and then. I know I'm gonna get my money back, and I'll get my 4% or 4.25%. And I'm saying, okay, that's better than
And
sitting.
then when
That's
if you
better
have
than sitting
a
money
fund,
market.
if you have them in a savings plan where when they mature, they buy new ones,
Right.
then you get your full whatever you bought them for, and then you buy new ones at 8%.
If rates go up.
Yeah.
It could be in 2 years, rates are back down below 4%, who knows?
Yeah.
But where I think it's happening, and there's been pretty good
You're not
demand.
losing money unless you
Unless you
sell
sell
a
it.
big chunk
Right.
of it.
Unless you sell it, rates go up and you sell it at a discount, yeah. Same with a stock, and if you think about it. Stocks do the same thing, there's just no guarantee at the end with stocks. It's just, you might have a big holding in Apple and it goes down 20%. Well, if you don't sell it, you don't have a realized loss, you have an unrealized loss, you don't have any kind of taxable event. If it comes back up, then you're even, no guarantee, like there is in a treasury bond, but. So, it's just, it's a very unusual period, I guess is the point I'm trying to make, and it felt that way to me, and I've been doing it a long time, and I've got some facts to back it up. It is unusual, 50 years since both markets are down, and the worst bond market for the aggregate index since its inception, so that's kind of paints the picture. If you scoot on over to, we'll look at page 6 for a minute. As Blake pointed out, if we'd have been meeting on September 9th, it just happens to be a day I was putting together some information for another client that was similarly allocated to you all. They were up 5.5% quarter to date. And then the last 3 weeks of September, everything went in the tank. So it ended up with a negative quarter. So you had a negative 4.6%. The ending market value is 27.4. Now here's the good news. This is the really good news, Skip. We're back down below 30 million, so if we get back up to 30 million, I can bring cupcakes again. So that's our strategy, to bring more cupcakes in. So the minus 4.6% is kind of in line. This is net of investment management fees, and so it was in line with the benchmark, actually, believe it or not. So, but you have given a lot of money back over the last year, over $6 million, 18.6% loss, a little worse than the benchmark. I'll show you why that's the case in just a second. And that's drug those longer term numbers down pretty substantially, which just a tremendous impact. The good news is you did have a 21.5% year last year, so if you do the 21 and the 18, in the last 2 years, you could say you're net positive a little bit. So when your actuary does his thing and smooths it, uses the smoothing method, and from that standpoint, I don't think you'll find this year will have a huge negative impact on your funded ratios and your funding requirements. Might increase your funding requirement. I'm just guessing because I'm no actuary, but might increase your funding by maybe a couple percent or something of to the city to fund the plan. But they do smooth it for a reason, and you do have a 21% last year that we're coming off of. But if you'd have asked me, seriously, if you'd have asked me, with a plan like this, as diversified as it is, you got best-in-class asset managers for each of these, say, 16 different asset classes you're invested in or managers you have. You get that well diversified with that kind of talent, and you tell me that you're going to have a year where you could have a positive 21 followed by a minus 18, I'd have told you no way. I think this is like a 4 standard deviation event or something. It's just not normal. And it's very frustrating for those of us in the business, and obviously for you serving as trustees for this pension fund. But the allocations on page 7, I'll skip over that, no major changes there. Blake reported, Blake has about 63% of the assets under that Sterling umbrella. The rest are outside of that, and those are funds that we recommend, or managers that we recommend to you. Not recommending any asset allocation changes. If you go to page 10, kind of get a feel for how things went. Again, the quarter on a gross, this is gross of fees, so the quarter was down 4.5%. The year was down 18.3%. Last year, that number was positive 21.7. Your 3-year number is now 3.8. 1 year ago, your 3-year number was 12.7. That's not on this page. I just had it. I looked it up before I came to the meeting. Your 4-year number is now 4%. 1 year ago, it was 11.7. And the 5-year went from 11.8 to 4.9. So, what we need is another 21% year on the other side to kind of bring things back to the norm and get those numbers back up. But it did have at least in the short run, had a pretty significant impact, obviously. Blake covered most of those asset classes. One of the 2 main reasons you underperformed your benchmark, the strategic model, would be large cap growth underperformed by quite a bit, and that's a fair amount of your assets. So that would be a big reason. And the other would be international. That Euro-Pacific fund that you're in, and you've been in for years now, underperformed quite a bit, got hit hard by it has kind of a growth style tilt, which owns its fair share of technology-oriented companies, and those got hit pretty hard. Tech stocks got hit really hard this last year, primarily because of the rising rate environment. That you're discounting their earnings with a higher rate now, so their future earnings, and that's what a lot of their valuation is all about. And also the strong dollar. Most of the big tech companies do a pretty significant amount of business overseas. When they get their earnings in foreign currency and translate it back into that dollar, it has a negative impact, and that really hurt them. So that's a short-term aberration, I would tell you, because I don't think there's a better long-term international fund out there. So just stay patient with them. That'll be fine. We are underweighted to the benchmark in international, and I'm going to keep you that way. I think there's just too much risk. Valuations are pretty attractive. It's pretty cheap, but there's a reason. And we're just thinking there's a little too much risk out there in the international markets to add any more just now. That real estate number of 1.5% is also one of the reasons why you underperformed. I said just 2, but really it's 3. And that's, as I said, that's kind of a mix. The REIT, this isn't on this page, but your REITs were down about 16%. Those are under the Sterling umbrella, and they got hit pretty hard. They're stocks, basically. I mean, they're real estate tied, but they're securities and have a higher correlation to stocks. We also put you then in that PREDEX direct commingled real estate fund. I think we did that, I want to say it's 2 or 3 years ago, but we put you in that not too long ago. Those were actually up, and that one was up 24%. So the combination wasn't too good, but we did have, support with that PREDEX fund. I'll show you that breakdown in a second. But again, the underreported story is that next line, fixed income down 13% for the year. That's supposed to give us some protection when stocks go down. It didn't happen. The list of all the funds starts on page 12, and you can see that breakdown in real estate that I was talking about. The Schwab REITs were down 16%, where the PREDEX was up 24%. I think there's anything else on there that we've already covered. I think Blake covered pretty much with his report. And then I guess maybe the last page I'll show you or talk about is page 16 to give you some perspective. I've been working with you a long time, and as I said, been in the business a long time. But these are your fiscal year returns from 2005. So that's going back, 17 years, and this is the worst year you've had. Interestingly enough, following the best year you ever had. So, unusual times, to say the least. But when it gets this noisy and this crazy, one thing we know for sure, and I had a chart in an earlier meeting I was talking to Patricia and Pam about on the 457 plan that showed drawdowns in the market, stock market, and what happens the next year. And almost every time, really it was 100% of the time when there was a big drawdown, say 30% or more in the stock market, sometime during the year, the next year was up strong. So you have to be there when this market turns. I don't know of anybody, including myself, that can time it. And so you gotta ride these rough periods. That's why I'm saying no asset allocation changes right now. I think you have to stay the course, and you know, hope your money managers do what you hire them to do, and that's find some really good stocks right now at some pretty good valuations. And when this market does turn, you know, we'll have another good year. And that's what we need, certainly next year after, when you look at that chart, that page 16 chart. So, any questions? Wish I had better news, but, you know, it is what it is, and hopefully we'll see a turn.
I have just your thoughts on, from either of you. I went to a conference that PFM did, and one of the economists that worked for those guys was talking about the housing market, and we've seen a huge boom. Just the market's just been really hot, most of Florida. But he said that it's already dropping off across the nation, and that Florida's kind of lagging behind that, but we're going to start seeing the housing market dropping again. Probably not to like 2008 type levels, but we are going to see, as the mortgage rates start going up, we're going to see a real decline in not just the movement of the market, but how much houses are selling for.
My wife's actually in real estate, and she's seeing it.
Here in Florida
yep.
already.
Yeah.
And the other thing is you have a generation that's coming into the home buying, the traditional home buying years that aren't as, you know, it's not a dream, you know, their
Right.
ultimate dream goal is to own a house anymore.
Yeah, I agree with that. The
So
demand will be off a little
They
bit.
feel like it's.
But they're gonna be forced
They feel like
into it.
it's an anchor, you know?
I think they're gonna be forced into it though pretty soon, because rents are going up so high. That's the flip side of this, and part of the inflation problem is rents are going up, and, you know, it gets to the point, there's somewhere there's that trade-off, you know, where your mortgage payment's less than a rent payment if you can get in there.
But it's more of a mentality
Yeah.
thing.
True.
I mean, some people are gonna get it.
They wanna be portable, they wanna get out, you know, they don't have to worry about selling.
Some
the house
people are
if they
gonna
can.
get it and say, hey,
Yeah.
buying a house is a good investment. You know?
And you know, just to show you, again, kind of talk about how crazy things are, just driving over here today, mortgage rates came out. Mortgage rates dropped by the greatest amount this week than they have in 40 years.
Mm.
They're down to 6.6 or something, 6.5 or 6.6, I think it was. So there was a big drop in rates this week, but it could go right back up next week. So, and also the numbers I was hearing were kind of interesting, depending on the location, but it was something like the average household income now has to be something like $130,000 to afford the average price house, average household price. So that's gone way up. So
Well,
what's interesting is the prices of the house, talking to my wife and watching what's happening, she's still had some pretty good deals going here the last few weeks, which is interesting, but the prices are kind of holding up right now.
right now.
And rates are still, you know, so a lot of buyers are out of the market, no doubt.
Well, it's also a lot of people aren't selling.
Well, a lot of
Which
people,
keeps the prices up.
yeah, the
because
supply
there's-
is gone. There's nothing
I
out
don't
there.
know, Palm Bay, geez Louise, my neighborhood, it's every other week, another, 50 acres seems to be cleared, because I'm out there with all those cow pastures. They're just clearing and.
Well, they're doing that on the west side of Orlando
Crazy
too.
amount of
Yeah.
construction of single-family residence.
Yeah,
I think Florida's an anomaly in as much as,
Yeah.
again, the way we were managed through the pandemic, there are a lot of folks in the Northeast.
and plus,
Down.
And the Northwest.
Yeah, they
Yeah.
just-
well,
everybody
plus,
wants to
you
know.
know what,
So it's creating a lot of that
The
demand
space-
for housing.
business and everything that's going on in the higher tech manufacturing there, jets and stuff in Melbourne and L3 and all that is just, you know, people are like, let's go to Florida, we can be free.
Get
we
great
can make
job.
as much money as anywhere else. We don't
And
have
not get
state income
taxed.
taxes.
Don't get taxed on it, and I agree.
265 beautiful days a year of sunshine.
And you buy, you know, and you get your trees all cleared out a couple times a year.
Yeah, yeah, nature
And
takes
all you
care
have
of
to
it.
do is pick it up.
Needs a generator.
All you gotta do is pick it up off the ground, you don't have to climb up there anymore.
And a second job for insurance.
Yeah.
Don't
mean,
forget about insurance.
But, well, the insurance is a problem,
Yeah,
but that's true, because like in the Pacific Northwest, they shut everything down.
Yep.
And a lot of the small businesses are gone.
Yeah.
They're just gone.
Tons.
They could not survive.
Well, they had that
the
high
shutdown.
rent, and if you don't have the income to cover your rent, you know.
I'll tell you, Blake and I travel too around Florida quite a bit, and I have definitely seen a lot more traffic. A lot more traffic.
And I think,
everywhere.
I think the
Well, we
rent
got,
pricing
we
is
gave you
already
that
getting
big
to the
raise, why
point
don't you
that
buy one of those flying
you
cars?
could almost, I think you're almost to that point where your mortgage is about the same as what you would pay for rent. The only difference is, of course, with a house, you have property insurance and
Down
property
payment.
tax on top of it, but when my little one finished, when she graduated, she was looking at apartments. I couldn't find a single bedroom for under 1,800
Yeah,
in
Yeah.
Palm Bay. She could buy a house and with less mortgage payment
Right.
in Palm Bay. Nice house, brand new house. And the only cost difference is property tax and
And-
insurance.
Yeah, and there's also that part about renting. You know, you're
You
fat, dumb, and
appreciate renting.
you're fat, dumb, and happy living there. You might have been there 3-4 years, and then they jack the rent up on you. Or they sell the place out and, you know, turn it into condos or something.
that's right. You gotta
Yeah.
move. I think renting's still very risky. All my kids ended up, they bought pretty quick. Fortunately, they bought when rates were low.
I think that's the other thing, I was reading an article the other day, from where interest rates started this year, mortgage rates, to where they are now, and it probably didn't include this little tip that we talked about. The median price of that, of a 1,600 square foot, 3-2 average little starter house, you know, skyrocketed up to darn near $400,000. But the difference between what mortgage rates were in January compared to what they were back in last month, you literally, your payment went from $1,800 to nearly $3,000.
Yeah.
If you didn't put anything down.
That's what they were
Just
saying.
on interest rates alone on a 30-year
Yeah.
basis.
Yeah.
We're getting back to the point where it's gonna be cheaper to buy a house than to buy one. Cheaper to build than to buy, like it was back in 04, 05 crash. It's like, I'm gonna buy a $400,000 house that I could build for 300.
That's a good point.
We're
That's a
getting
really
back
good
to
point,
that.
especially with lumber coming down like
Yeah.
it has and supply chains
All right,
improving.
are we done pontificating?
Yep.
We're not gonna solve the world's problems?
Not today, but we do have one informational item today. Mr. Brad Kelslow's term expires in February 2023, so sometime in that first quarter vicinity, we'll be doing another election
The employees.
Yes, in
That's your
place.
speech written
for Brad's.
for your-
Hopefully he's
your
gonna,
reelection campaign.
hopefully he's going to.
Hey Brad, if you need any re-election tips, I'm batting 1,000.
And yes, you would be encouraged to
Pensions matter.
continue to express interest.
Money matters.
I'm just playing.
I had that Residents Matter thing going 15 years ago,
Yeah, yeah.
before Black Lives Matter,
Yeah.
Matter, Blue Lives Matter.
It's a good slogan.
Our next quarterly meeting is February 16th. Does the board have any questions? Then we are officially adjourned.